Hello traders, Igor here, MrTopTick.com. Welcome back to the channel. If this is your first time tuning in, consider subscribing to the channel, leave a like, and share this video with somebody you think could benefit from this. Today, I want to talk about bear traps that we had started to initiate in the Income Navigator Trade Alert service. This is not a substitute, but an addition to the typical 1-1-2 bear traps that we do every single week. I do realize that we have traders that are not able to get involved in 1-1-2 bear traps for various reasons. Could be size of the account, not willing to sell SPX options naked. So in an effort to solve that issue, we have introduced a defined risk bear trap. This could also be looked at as a unbalanced put condor, where we buy to open a put debit spread, and that put debit spread is almost fully financed by a sale of further out of the money put credit spread. We initiate these for a small debit, maybe for a small credit, depending on our market outlook near term, and then we go through several adjustments along the line of rolling our either debit spreads or credit spreads to recover initial debit if we put the trade on for a debit. And our goal is to generate somewhere between 10 to 15% return on risk. And this is a trade we have initiated 24 days ago. This is a bear trap that has 23 days left. So we're kind of halfway in the cycle of this trade. And we've made several adjustments. We have rolled our put debit spread closer to the body of this bear trap. We also rolled our credit spread closer to the body. We have our risk down to just a little over 14,000 from 18,000 where we started. And we were able to recover all of our initial debit. And now over the next 23 days, we're either going to hold this position, or maybe we'll make another one or two adjustments to potentially increase our return if S&P remains above 40-50. And there's still a chance that, over the next, let's call this 18 days, if we look at this dark gray area, this is the expected move based on current implied volatility. And if we do move to the tune of -1 expected move from today's prices over the next 18 days, with 5 days until expiration, we still have an opportunity, or we still have a chance that S&P may end up in the bear trap, and that is going to boost return on risk for this trade drastically. We also initiated another trade today for the members of Income Navigator. This is a S&P defined risk bear trap in the June 23rd expiration cycle, with about 46 days until expiration. Hope you enjoy this trade. If you have any questions, leave them in the comments. We'll talk to you next time. All right, let's have a look. This is a trade setup in the SPX. S&P 500 right now is at 41.35, and we're going to set up a defined risk bear trap. It has a slightly different risk profile compared to the 1-1-2 bear trap that we normally do. However, the benefit here is that we do have defined risk, and this trade also provides us with quite a bit of flexibility in order to manage this trade from start to finish, making adjustments if needed, depending on what the market is doing, while trying to maintain as close to delta neutral as possible. So the basic setup here, and I was just going over some sort of way to kind of normalize this trade and make it a very, very easy to follow and repeatable process for everyone. So I think that one of the best ways to figure out how to put this trade on would be to look at current expected move. We can also look at a price of an at the money straddle. S&P at 41.34, so we can look at 41, either 35 or 41.30 options, and we're pricing at about a 160-point move over the next 46 days in either direction. So what I would do is I would just take a half of the expected move, which is about 80 points. So I would go about 80 points out of the money, and that's where I would place my upper long put. And this is a part of a put debit spread. I'm going to use a 50-point wide put debit spread. So I go 80 points out of the money from current market price, and I'm going to buy to open a 50-point wide put debit spread, just one of those. And then to cover the cost of this put debit spread, I'm going to go further out of the money and buy two 50-point wide put credit spreads. And my apologies if I said I will go out and buy. I'm going to sell two of the 50-point wide put credit spreads. Now, the put credit spread that we're selling further out of the money, we're selling two of those. The credit that is being collected will go to offset almost all of the cost of the one put debit spread that we are buying. And this will leave us with a net debit for the entire position of about 70 cents or so, or 80 cents. And that is our risk on the upside or anywhere above the put debit spread. Now, this trade has a couple of potential outcomes here. If S&P 500 expires above 40.60, we could potentially lose the 70 cents, right? This is what is costing this trade, at least to put this trade on. We have a small debit if we do nothing else and let S&P expire somewhere above 40.60. That 70-cent debit is at risk. If we expire, or if we end up somewhere inside of this put debit spread and the two of the put credit spreads, the put debit spread is going to be worth its max potential value, or 50 points, or $5,000 for one lot, minus the small debit. So we could potentially make inside the bear trap at expiration just shy of $5,000. It would be $5,000 minus $70. So it's $4,930 to be exact. Right? So our put debit spread would expire in the money worth full max potential value minus debit, and the short out of the money put credit spreads would expire worthless. And another scenario, if S&P expires somewhere outside of our downside break even, which is currently at around 38.25. This trade has a potential loss on the downside of just about $5,000 plus the debit that we're paying. So it would be $5,070 if we are paying 70-cent debit to put this trade on. You could also look at it like this. The downside risk or the buying power requirement for this trade is going to be, let's assume that we expire under 3,800. We will, at this point, have a put debit spread that is going to be worth $5,000, but we have two of the put credit spreads that are 50 points wide, so that's 5,000 times 2. So we'll have a $10,000 loss from the put credit spreads, and we'll have a $5,000 gain from the put debit spread. So 10,000 loss, $5,000 gain. That will leave us with a net loss of $5,000 plus the small debit that we're paying. So we have a downside potential loss of $5,070. That is if we do nothing else. Obviously, that is not our plan here. What we are going to do, depending on how fast the market is moving and how much time will run off the clock, the idea would be, number one, is to recover the 70-cent debit that we are paying. Well, now the mid price is showing about 85 to 90 to about $1 debit to put this trade on. Whatever that debit is, our first goal is to recover the debit to make it a risk-free trade above 40.60. And we're going to do that by probably pinching the wings or rolling our long options, the 40.60 put or the 3800 put. These are our long options in this trade. We're going to roll these puts closer towards the body or inside the bear trap. And this is going to shrink the size of the bear trap, which is a negative. But the positive is we're going to be able to remove upside risk. We're going to recover the debit, and we're also going to try to remove downside risk at the same time. So that is my trade setup for June 23rd. Buying to open one 50-point wide put debit spread, and I am selling to open two 50-point wide put credit spreads. It is currently going, and the strikes are, so for the put debit spread, I'm buying to open 40.60, 40.10 put debit spread, and I'm selling two of the 38.50, 3800 put credit spreads, and this is all in June 23rd expiration cycle. Current price for this trade is about 70-cent debit. Right, we want to pay as little as possible. So when I put this trade on, I'm going to start off with about a 70-cent debit. If I don't get a fill, I'll raise the price to 75 cents, then to 80, 85, 90. I don't want to pay more than $1. $1 debit is my limit. And if I don't get a fill, I'll come back tomorrow and we'll set up the exact same trade, maybe different strikes depending on where the market is. But the structure of this trade is going to be a 50-point wide put debit spread, financed mostly by a sale of further out of the money put credit spread, and there are going to be two put credit spreads for every one put debit spread.